Join me as I take on the challenge of mastering risk management to see if I can invest like a pro and maximize my returns. Risk management is a crucial aspect of investing that often gets overlooked, but it's what separates the pros from the amateurs. In today's video, we're going to explore the importance of risk management and how it can literally make or break your investment portfolio. When it comes to managing risk, many investors face a common challenge: fear. Fear of losing money, fear of making the wrong investment, fear of not knowing what to do in times of market volatility. This fear can lead to impulsive decisions, emotional reactions, and ultimately, poor investment choices. In fact, it's estimated that nearly 70% of investors make emotional decisions when it comes to their investments rather than making informed, data-driven choices. Another challenge investors face is lack of knowledge. They may not understand the various risk management strategies available to them, or they may not know how to implement them effectively. This lack of knowledge can lead to a false sense of security, causing investors to take on more risk than they can handle. Furthermore, some investors may be overconfident in their abilities, thinking they can outsmart the market or time their investments perfectly. This overconfidence can lead to reckless behavior and a failure to diversify their portfolios. And finally, some investors may simply neglect risk management altogether, thinking that it's not important or that it's too complicated to bother with. Diversification is a key risk management strategy that involves spreading your investments across different asset classes, sectors, and geographic regions. By doing so, you can reduce your reliance on any one particular investment and minimize your exposure to market fluctuations. For example, let's say you have a portfolio that's heavily invested in the tech sector. If the tech sector experiences a downturn, your entire portfolio could take a hit. But if you had diversified your portfolio by investing in other sectors, such as healthcare or finance, you would be less exposed to the downturn and better positioned to weather the storm. Asset allocation is another important risk management strategy that involves dividing your portfolio into different asset classes such as stocks, bonds, and cash. This can help you balance your risk and return, ensuring that you're not taking on too much risk or too little. For instance, if you're a conservative investor, you may want to allocate a larger percentage of your portfolio to bonds, which are generally less risky than stocks. On the other hand, if you're a more aggressive investor, you may want to allocate a larger percentage of your portfolio to stocks, which have the potential for higher returns. Setting stop-loss orders is a risk management strategy that involves automatically selling a security when it falls below a certain price. This can help you limit your losses and prevent a small decline from turning into a major catastrophe. For example, let's say you buy a stock for $50 and set a stop loss order at $40. If the stock price falls to $40, the stop loss order would be triggered and you would automatically sell the stock, limiting your loss to $10 per share. Another risk management strategy is position sizing, which involves determining the optimal amount of capital to allocate to each investment. This can help you manage your risk by limiting the impact of any one investment on your overall portfolio. For instance, if you have a $10,000 portfolio, you may decide to allocate no more than $1,000 to any one investment. This way, if the investment doesn't perform well, you won't lose too much of your overall portfolio. One of the most effective risk management techniques is what I call the 2% rule. This involves limiting your exposure to any one investment to no more than 2% of your overall portfolio. This can help you avoid putting too many eggs in one basket and minimize your risk. For example, let's say you have a $10,000 portfolio and you want to invest in a particular stock. Using the 2% rule, you would only invest $200 in that stock rather than $1,000 or more. This way, if the stock doesn't perform well, you won't lose too much of your overall portfolio. I've seen this strategy in action with numerous successful investors, and it's truly remarkable how well it can work. One investor I know was able to grow his portfolio by 20% per year for 5 straight years using this very strategy. In conclusion, mastering risk management is essential for achieving maximum returns in your investments. By diversifying your portfolio, allocating your assets wisely, setting stop-loss orders, and using position sizing, you can reduce your risk and increase your potential for long-term success. And by following the 2% rule, you can take your risk management to the next level and achieve truly remarkable results. Thanks for watching, and don't forget to comment below with your own experiences with risk management. And if you're new here, consider subscribing for more investment tips and strategies to help you invest like a pro.